$550 million. The number lands differently depending on where you are in your financial life. If you have $12,000 in savings right now, $550 million is so far outside the frame it barely registers as a real thing. But here is what is interesting. The people who actually have it are not on a list you can find. They are not in a profile you read this week. They go to the same grocery stores. They sit in the same traffic. The wealth is real and the anonymity is also real, and that combination is not accidental. It is engineered. What this video is about is how that works. But before you can understand how someone stays unknown at that scale, you have to understand what $550 million actually is. Because most people have a wrong mental model of it, and the wrong model leads to wrong conclusions about everything that follows. Start here. Net worth is not cash. This is not a small distinction. When someone's net worth is reported at $550 million, that figure is an estimate of total asset value minus total liabilities. It is not a balance sitting in an account somewhere waiting to be spent. A person worth $550 million might have $4 million in liquid cash on any given Tuesday. The rest is elsewhere. It is in a business they founded that now has a $300 million valuation. It is in a concentrated position in a single stock that cannot be sold quickly without moving the price and triggering tax consequences that require their own planning process. It is in commercial real estate across 3 markets, and 2 of those properties are mid-sale and not yet settled. It is in a private equity fund with a 7-year lockup that still has 4 years remaining. Wealth at this level is a portfolio of positions, many of which are not convertible to cash on short notice. Understanding that changes everything. Now let's translate the number into something operational. A common framework in financial planning is the safe withdrawal rate, the percentage of a portfolio you can draw annually without depleting the principal over a long time horizon. The widely cited figure is 4%, derived from historical research on portfolio longevity. At $550 million, 4% is $22 million per year. That is the number you can spend year after year without meaningfully eroding the base, assuming the portfolio is invested and generating returns. $22 million annually, that covers essentially any personal consumption you can design. It covers multiple properties maintained at a high level. It covers staff, travel, philanthropy, legal, advisory, and every other category of expenditure associated with life at that tier. The constraint at $550 million is not whether you can afford something. The constraint is something different, and we will get to it. Now let's look at where the money actually lives, because the composition of a $550 million fortune matters more than the headline number. At this level, wealth is typically concentrated in a small number of large positions. A founder who built a regional distribution company to $400 million in enterprise value and owns 70% of it has a net worth above $250 million, but their fortune is almost entirely tied to one illiquid private business. If that business has a bad year, the fortune contracts. If they want to access the value, they have to sell equity or take on debt against the asset. Neither is a simple transaction. Concentrated public stock is a different challenge. A person holding $200 million in a single company's shares faces a problem that sounds absurd from the outside, but is completely real. Selling that position quickly moves the stock price. It triggers capital gains taxes on the appreciation. It may violate insider trading windows if they are a company officer or board member. The wealth is visible on paper and largely inaccessible in practice without a structured disposition plan that can take years. Real estate at this scale has its own liquidity profile. Commercial assets, development land, multifamily portfolios, these generate income and appreciate in value, but they cannot be converted to cash in a week. Private fund investments, venture capital, private equity, hedge fund structures, these have defined lockup periods and redemption windows. The capital is committed. It is not available on demand. What this means practically is that a person with $550 million in net worth spends a meaningful portion of their financial life managing cash flow separately from wealth. Income has to be engineered. Dividends from a business, distributions from a fund, rental income from a property portfolio, salary, or draws from operating entities. The day-to-day spending of someone with $550 million is funded by income streams that have to be designed and maintained. The wealth itself sits in positions. The cash flow is what actually runs the life. This creates 3 distinct categories of risk that wealthy individuals manage simultaneously, and they are not the same problem. The first is solvency risk, running out of money. At $550 million, it is a remote concern but not a zero concern. Poor investment decisions, catastrophic liability exposure, or severe and sustained market deterioration can erode even a substantial fortune, particularly when it is concentrated. The second is legal and compliance risk. At this level, every financial decision has tax implications, reporting requirements, and potential regulatory exposure. Structures that are technically legal require ongoing maintenance to stay that way. The third is attention risk. This is the one most people do not think about. Visibility invites scrutiny, litigation, social pressure, reputational exposure, and unwanted contact. Wealth at $550 million creates a target. Managing that target is its own discipline, separate from managing the money. The people who do this well understand that the goal is not to seem poor. It is to be unremarkable. There is a difference. Seeming poor is a performance. Being unremarkable is a structural outcome. It comes from how accounts are titled, how assets are held, what entities own what, where filings are made, and what names appear publicly versus which do not. It is built into the architecture of the wealth, not applied as a surface layer afterward. That architecture is what the rest of this video covers. How large wealth gets structured to stay private, how it gets protected from the specific risks that matter at this scale, and how it gets used charitably, practically, generationally, in ways that are both effective and quiet. The money is real. The visibility is a choice. How that choice gets made is the actual subject. Most people assume that wealth at this scale is visible by default. That if someone has $550 million, some record somewhere has their name next to the number. That is not quite how it works. The visibility of wealth is a function of how it is held, not how much of it exists. The structure determines the exposure, and the people who stay unknown understand that before anything else. Start with where the wealth actually comes from. The wealthy individuals most people can name are wealthy because of events that created public records. An IPO, a celebrity, a major acquisition covered in the business press. But the majority of high net worth individuals in the United States and globally did not become wealthy through any of those mechanisms. They built a regional pest control company to $80 million in revenue and sold it. They developed a portfolio of self-storage facilities over 20 years. They ran a mid-market manufacturing operation in an industry nobody writes articles about. The wealth accumulated quietly because the industry was quiet, the exits were private, and nothing in the process required public disclosure. There was no moment that put them on a list anyone reads. That is not concealment. That is just how most private businesses work. The entities matter as much as the industries. When assets are held personally, they appear in personal records. When assets are held through entities, the entity appears in records and the individual does not, or appears only at a level of abstraction that requires deliberate effort to trace. A limited liability company owns a commercial property. The LLC is the record holder. The operating agreement naming the members is not a public document in most states. A trust holds a brokerage account. The trustee is named on the account, not the beneficiary. A holding company owns interests in 3 operating businesses. The holding company files a return. The individual who owns the holding company is upstream of everything visible. None of this is unusual. It is standard legal architecture for people with substantial assets, and it works because it is legitimate. The common structures at this level are worth naming specifically. LLCs are used to hold real estate, investment accounts, and operating interests because they provide liability separation and, depending on the jurisdiction, limited public disclosure. Trusts, both revocable and irrevocable, hold assets in ways that keep the beneficiary's name off the public record and often allow assets to transfer without going through probate, which is a public process. Holding companies, typically structured as LLCs or S corporations, own the operating entities and consolidate economic control without that control appearing in the name of any individual in any single public filing. In some jurisdictions, nominee officers or registered agents are permitted, meaning the name that appears in a state business filing is a professional service provider, not the actual owner. Wyoming, Delaware, and Nevada are frequently cited in this context because their disclosure requirements are minimal. These structures require legal counsel to establish correctly and ongoing maintenance to keep compliant. They are not do-it-yourself arrangements at this scale. Here is what is important to say clearly. None of this is actually private from the people who need to know. Banks know who their customers are. Brokers know who their account holders are. The IRS knows who filed the return and what the underlying income and assets were. Anti-money laundering regulations and know your customer requirements exist precisely to ensure that financial institutions can see through entity structures to the beneficial owner. If you have a trust account at a brokerage, the brokerage has documentation identifying the grantor, the trustee, and the beneficial owner. That documentation exists and is maintained and is available to regulators. The privacy these structures create is privacy from the general public, from data aggregators, from litigation plaintiffs searching court records, from journalists running basic searches. It is not privacy from authorities. Anyone who conflates those two things is operating under a dangerous misunderstanding. The structures work because they are transparent to the right parties and invisible to everyone else. Beyond entity structure, there are practical habits that reduce public exposure over time. A separate legal address for entity filings keeps a personal residence out of public business records. This is standard practice. A P.O. box or a registered agent address serves the same function. Disciplined management of the digital footprint means not associating personal names with business entities in social media, press mentions, or professional directories when that association is unnecessary. It means understanding that data brokers aggregate public records and that opting out of those databases is possible and worth doing. It means that photographs, location data, and property records all create trails, and at a certain level of wealth, those trails have consequences. The social dynamics of this are underappreciated. When the people in your personal and professional life do not know the scale of your wealth, requests stay proportional, relationships stay functional, and the pressure that wealth attracts does not materialize in the same way. This is not about being dishonest. It is about recognizing that volunteering financial information serves almost no one in most social contexts. Boundaries can be maintained without rudeness. Declining to discuss finances is not unusual behavior. Most people with serious money simply do not bring it up. The conversations that never start cannot become problems. The security dimension is real and specific. Impersonation fraud increases with net worth. Doxing, the deliberate public exposure of personal information, is a tool used to pressure people or expose them to secondary targeting. Operational security at this level means using unique email addresses for financial accounts, enabling multi-factor authentication, working with legal and financial professionals through verified contact methods, and knowing that the people most likely to target high net worth individuals are the people who find out about them through data leaks, data brokers, and social exposure. Quiet wealth reduces the surface area. Reducing the surface area reduces the risk. One line is worth drawing explicitly and in full. Privacy from the public is not the same thing as privacy from the government. The structures described here are legal. They are used by attorneys, accountants, and financial professionals who operate with fiduciary obligations and professional licenses. Tax evasion is not a privacy strategy. It is a federal crime. Every entity files returns. Every account is reported. Beneficial ownership registration requirements are expanding, not contracting. The entire point of these structures, done correctly, is full compliance with every reporting obligation, combined with minimal unnecessary public disclosure. Anyone advising otherwise is not advising you. They are exposing you. The people who stay unknown at 550 million are not hiding. They are structured. That is a different thing entirely. Having the money and keeping it are two different problems. The second one is harder and less discussed. Most of the literature on wealth covers accumulation. The part that comes after, the part where 550 million has to be maintained, governed, protected, and allocated across decades, receives less attention partly because fewer people reach it, and partly because the people who reach it are not publishing their notes. Start with the core threat. Concentrated risk is the dominant way large fortunes shrink. A business founder exits a company and holds 80% of net worth in a single stock in a single sector. A real estate developer has everything tied to commercial properties in two adjacent markets. A private equity partner's net worth is almost entirely illiquid and correlated to credit conditions. The number is large, the structure is fragile. Diversification at this level is not a philosophical preference. It is the primary engineering problem. And it has to be done carefully because exiting a concentrated position too quickly creates its own problems. A large block sale moves markets. It signals to other participants. It triggers immediate taxable events. The pace of exit matters as much as the direction. Stage sales over multiple years, exchange funds that pool concentrated positions without immediate recognition, charitable vehicles that absorb appreciated shares, all of these exist specifically to solve this problem without destroying the position in the process of leaving it. The tax reality is unavoidable and worth stating plainly. Long-term capital gains rates at the federal level reach 20%. Add the net investment income tax and state taxes in certain jurisdictions, and the effective rate on a large exit can exceed 30%. On a $100 million position, that is $30 million that does not transfer. Tax strategy at this scale does not start with exotic structures. It starts with cash flow forecasting, understanding when income is recognized, in what form, and in which tax year. From there, charitable strategies become meaningful. A donor-advised fund accepts appreciated securities, generates an immediate deduction, and allows grant-making over time. A charitable remainder trust provides income, a deduction, and eventually transfers the remainder to a designated cause. These are not loopholes. They are instruments with long legal histories that function exactly as designed when used correctly. Estate planning concepts at this wealth level involve gift and estate tax exemptions, generation skipping structures, and irrevocable trusts designed to transfer appreciation out of the taxable estate. The details require an estate attorney. The principle is that tax strategy is not a one-time event. It is an ongoing operational function that runs in the background every year. Asset allocation at $550 million can be described in plain language without losing the substance. Think in buckets. The liquidity bucket holds 1 to 3 years of planned spending in cash and short-duration instruments. It is not there to earn a return. It is there so that nothing else has to be sold at the wrong time. The growth bucket holds equities, private investments, and real assets oriented toward long-term appreciation. It is the engine. It tolerates volatility because the liquidity bucket insulates it from forced selling. The inflation hedge bucket holds real estate, commodities exposure, and inflation-linked instruments because $550 million over 40 years faces inflation as a material risk even if it rarely feels urgent in any single year. The defensive bucket holds investment-grade fixed income and positions designed to hold value when growth assets fall. The specific percentages inside each bucket depend on the individual's time horizon, tax situation, liquidity needs, and risk tolerance. The structure of the buckets is not optional. It is the difference between a portfolio and a pile. Governance deserves its own attention. The biggest financial mistakes made by people with significant wealth are almost never the result of ignorance. They are the result of impulsive decisions made without a system to slow them down. An investment policy statement is a written document that defines objectives, constraints, target allocations, and the process for making changes. It exists so that a compelling pitch at a dinner does not become a wire transfer. Decision checklists, waiting periods before any commitment above a defined threshold, mandatory second opinions from an advisor with no stake in the transaction, these are not bureaucratic obstacles. They are the governance architecture that wealthy families use to protect themselves from their own worst moments. The team is essential, and the team has to be vetted carefully. A fiduciary advisor is legally obligated to act in your interest. A salesperson is not. These two roles can look identical from across a conference table, and the difference determines everything. The question to ask is direct. Are you a fiduciary in this relationship, and will you put that in writing? A CPA handles tax compliance and planning coordination. An estate attorney handles entity structure, trust documents, and wealth transfer. A security consultant, often underutilized, handles digital exposure, physical security planning, and travel protocols when those become relevant. Each of these relationships requires ongoing review of incentives. Advisors who are compensated by product commissions have a structural conflict, regardless of their intentions. Fee-only arrangements remove the conflict. The vetting process matters more than the credentials on the wall. Lifestyle inflation and relationships deserve a direct sentence. Wealth does not stabilize relationships by default. It pressures them. A written spending policy, not a rigid budget but a documented philosophy about what spending is for and what it is not, provides a reference point when the pressures become specific. Gifts to family members can support people or create dependency, and the difference is not always visible at the moment of giving. Being respectful of others' financial situations means not calibrating generosity in ways that undermine the recipient's own sense of agency or competence. The goal of financial stability is not to maximize the number. It is to build a structure where the money does what you want it to do for as long as you need it to, without requiring your constant attention or your constant anxiety. The money stays when it is governed. That is the operating principle. The money is governed. Now the question changes. Not how to protect it, but what to do with it. What it is actually for. That question sounds simple. It is not. Most people who reach significant wealth have spent years focused on the mechanics of accumulation and preservation. Purpose is a different kind of problem, and it does not resolve itself automatically once the balance sheet is secure. Without a deliberate answer, the default is consumption. Consumption is not inherently wrong, but it is not a plan. And at $550 million, consumption without direction tends to produce more complexity, more exposure, and less satisfaction than the number on paper would suggest. Define the goals first and define them beyond what you can buy. Time is one, health is one. The quality of attention you can give to family, to learning, to the things that matter to you before the money existed, those are goals. So is community impact, the specific ways your capital can do something in the world that your labor alone never could have. Write these down in the same way you would write an investment policy statement. Not aspirationally, precisely. What does time well spent look like at 55, at 70, at 85? What does contribution mean to you in concrete terms? The written version becomes the standard against which decisions get measured. Philanthropy at this scale has infrastructure options worth understanding. A donor-advised fund is the simplest entry point. You contribute appreciated assets, take the deduction in the year of contribution, and make grants over time to qualified organizations. There is no requirement to publicize the fund or identify yourself as the source of grants. A private foundation offers more control over grant-making strategy but comes with administrative requirements, minimum annual distribution rules, and greater visibility into your identity as the funder. Scholarships and name-giving programs are powerful but carry their own visibility. If privacy is a priority, the donor-advised fund structure preserves it better than most alternatives. Evaluating impact without publicity is possible. It requires asking direct questions of grant recipients, reviewing program outcomes data, and building a framework for what success looks like before the money moves, not after. Effective giving is not about the dollar amount. It is about whether the dollar amount changed the specific outcome you were trying to change. Values-based investing and community investing are distinct from philanthropy but worth addressing in the same section because they reflect the same question. What do you want the capital to do? Aligning a portion of the portfolio with specific outcomes, community development, financial institutions, mission-aligned funds, direct investments in businesses that address problems you care about is possible without abandoning fiduciary discipline. The key word is portion, a defined allocation, sized within the structure of the larger portfolio so that underperformance in that sleeve does not compromise the whole. Due diligence does not change because the investment is values-aligned. It becomes more important because values-aligned investments vary enormously in quality and the term itself is not regulated. Verify the financial structure. Understand the return expectations honestly. Size appropriately. The intention and the analysis both have to be present. Legacy planning is not a single document. It is an ongoing architecture. Wills and trusts establish where assets go. But the more durable question is what you want the recipients to carry forward and whether the inheritance itself will support their lives or complicate them. Heirs who understand the source, the discipline, the structure, and the responsibility of inherited wealth are different from heirs who simply receive a number. Education matters here. Not a single conversation, but a deliberate multi-year process that introduces financial concepts proportionally to age and readiness. Guardrails built into trust structures, staggered distributions, incentive provisions tied to education or employment, spending oversight mechanisms exist specifically because well-intentioned transfers of large capital to unprepared recipients produce outcomes that the original holder did not want. The goal is not control from beyond the grave. It is care taken early enough to make control unnecessary later. The cost of nobody knowing deserves a direct statement. Sustained privacy around wealth can produce isolation. It can generate a version of daily life where every new relationship carries a background question about motive that the other person cannot see but you cannot turn off. Managing that is not a financial problem. It is a relational one. The answer is not disclosure. It is clarity about what you will and will not share, applied consistently with enough warmth in the relationships themselves that the boundary does not become the relationship. Trusted people exist, the vetting takes time. The relationships require maintenance like any others. The cost of not investing in them is loneliness at a balance sheet that should not produce it. A simple annual rhythm makes all of this sustainable. Once a year, review spending against the written policy. Review the tax picture for the coming year and the year after. Review the portfolio allocation against the target. Review the privacy posture. What has changed in exposure? What requires adjustment? Review the purpose goals. Are you actually spending time on what you said mattered? Has the answer to that question changed? An hour with each member of the advisory team. A conversation with yourself about whether the structure is still pointed in the right direction. That is the maintenance cycle. It is not complicated. It has to be scheduled or it does not happen. The takeaway is this: a large number managed without purpose is just a number. The people who use significant wealth well tend to share a few common traits. They wrote down what they wanted before they decided how to deploy capital. They built systems instead of making individual decisions under pressure. They protected their privacy without letting it close them off entirely, and they treated the annual review not as a chore, but as the actual practice of using money intentionally. If this kind of practical, unembellished financial thinking is useful to you, subscribe. There's more of it here.